Hello and welcome. You're watching India Today. I'm Sakshi Batra and this is our special edition on Budget Unlocked. Stock market investors, both large and small, are hoping for big budget booster on the 1st of February. Retail investors are particularly concerned, given the recent dip in their fortunes. Markets and most stocks are down from their highs last year and investors are staring at losses. Here's a look at what market participants are clearly expecting from the Union Budget 2025.
The bull at the entrance of the Bombay Stock Exchange on Dalal Street in Mumbai is on a break. The record peaks being hit every day are no longer visible in the winter fog, and even investors who entered the relatively safe world of systematic investment plans in 2024 are facing negative returns. The Nifty, the bellwether index of 50 most actively traded blue chips, has tumbled more than 11% since its September high of 26,277. The mid-cap 100 index is down 12.5% from its highs. Some sectoral indices have fared worse, with the NSE index of government-owned companies down to 23% from its high. The FMCG and the consumption indices are both down more than 16%, while the infrastructure companies have fallen 15% on an average. Banks are down more than 9%. The biggest reason has been a significant exodus of foreign investors, with outflows reaching 2.65 lakh crore rupees since August 2024. The shock has been cushioned in part by domestic investors who have ploughed in 3.48 lakh crore rupees in the same period. The foreign outflows have been driven by concerns over high valuations and weak corporate earnings in India, and a strong dollar prompting FIIs to seek better returns elsewhere, particularly in the US bonds. Market players meanwhile feel the budget could focus on several key areas to enhance market liquidity and growth. These include the long-standing demand for low security transaction tax or STT rates and a review of a long-term capital gains LTCG tax rates. The tax was increased by 12.5% from 10% in Budget 2024. An increase in government capital expenditure will help stimulate economic growth and help the infra sector. The mutual fund industry is also seeking measures to enhance investor participation, such as tax incentives or simplified regulations. Markets are also looking for an expansion of the production-linked incentive PLI schemes to more sectors. Investors are also looking beyond the budget 2025 to the actions of the new US President Donald Trump. Many foreign investors are already reallocating their portfolios towards markets perceived as offering better returns, such as the US and China, especially following recent stimulus measures in China. Any new tariffs on Indian goods by the new administration in White House could muddy the waters further. Bureau Report, Business Today Television.
Meanwhile, in a crucial move, the US Federal Reserve last night decided to keep its interest rates unchanged in the 4.25 to 4.5% range. Now, this comes right after the US Central Bank had cut rates from a high of 5.5% in 3 tranches beginning September of 2024. And this decision also comes right ahead of RBI's Monetary Policy Committee rate decision that comes in on 7th of February. Here's what Jerome Powell had to say about the rate decision and the possible Trump tariffs.
With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So,
will the budget 2025 bring back bulls to the D Street? That's the one question that everybody is asking. And to answer this question and to find out what is the big budget wish list from D Street as well as the investors at large, we have a panel of veteran experts joining in on this conversation. I have with me joining in Mr. Vaibhav Sanghvi. He's the CEO at Ask Hedge Solutions. And also joining in is Mihir Vora, CIO, Trust Mutual Fund. And to also take this conversation forward with me here in the studios is our editor, Mr. Siddharth Zarabi. Warm welcome to all of you.
Very warm welcome, Vaibhav and Mihir. Sakshi, I'm going to kick this conversation off by that very big question that hangs heavy in the air literally just a couple of days before Budget 2025, a very important policy prescription for a economy that seems to be in the midst of a slowdown. Now, there is a debate whether it's a cyclical or a structural slowdown. I will come to you first. Mihir, what's your reading of the overall economic impulse at this point of time, and do you think the budget will be a significant factor for market trajectory in the weeks and months ahead?
Sure. Hi, Siddharth. Always a pleasure to be here. Hello, Sakshi. See, the budget comes at a very interesting time, I would say. And the cause and effect are a bit, difficult to kind of figure out what is the cause, what is the effect. But the fact of the matter is that we have done a lot for the rural economy in the last year, especially at the state levels. And there are some indications that at least the rural consumption piece seems to be stabilizing. Okay. Now, we were hoping that while the urban consumption remains strong, and rural revives, it should be a good cyclical recovery for the economy. However, it looks like, and it's not conclusive, so let's not jump to conclusion, but it does look like there is some let-up in the urban piece while the rural is stabilizing, so to say. Now, the reasons can be manifold, but one of the reasons is also the fact that government capex spending was not as planned for this year, financial year 24-25, maybe because of election year slowdown, etc. But the fact remains that on the capex front, the government did not spend as much. So there is the element of maybe 0.5% or maybe 1% of GDP, probably that we could have done better in terms of growth if the government spending had gone as per plan, so to say. So I think with that low base, the platform for FY26 is a little, I would say, easier to kind of maintain that growth rate because if the government does go back to 11 lakh crores or 12 lakh crores of capital spending in FY26, then on a low base we should see growth coming back. And if the urban economy does stabilize, then I think we should be in for a next decent year. I think by default, the nominal GDP growth rate is about 10.5 to 11% for next year. We should expect tax collections and expenditures to rise along those levels. And naturally, if that happens, then the deficit should anyway be on the path to 4.5% in terms of consolidation. So I think the math is not very complicated if things don't completely go off rail. However, having said that, there is a case for something for the tax-paying middle classes, the urban consumption, because we do need that extra support, given the fact that we are in a little bit of a slowdown on the urban side.
Right. Mrs. Sanghvi, let me get you into this conversation as well. I think boosting consumption is a big ask right here, right ahead of the union budget. But I want to ask you from the market's perspective, what exactly needs to be done for boosting consumption? And also, will that be enough to pull the Nifty out of this 4-month-long consolidation?
Good evening, guys. But, while Sakshi, you did ask about the question about boosting consumption, what I would think about, first of all, is that whether, after 10 years of the current government focus into the capex side or the supply side, is it something that the government would want to probably deviate from that path and start, giving an impetus to the, consumption side? Of course, from a central government and the state government, both are going a little bit of an opposite direction, where you are seeing state governments actually doling out, in terms of the welfare schemes, wherein we are seeing, some amount of that effect, coming back into the consumption side. However, would the central government kind of play that part is something to be seen. I'm not sure yet that the government is in, maybe in that full mode of boosting consumption. Having said that, I think, as Mihir also alluded in terms of the capex revival, it's going to be an extremely fine line or a thin line to kind of balance between the sources of revenue from a government perspective to the expenditure which they will be able to do. Why do I say so? Is because last year fiscal deficit is about 4.8%, going to FY26, targeting about say 4.4 to 4.5%. And looking at the taxation revenue kind of weakening a little bit, how is it that would be able to kind of go on that fiscal path? At the same time, to try and give a boost to the economy either by capex or by consumption boost. Which is why I think day after tomorrow, I think it's going to be an extremely important day to see how the government, kind of pushes forward the whole agenda, and it will be very interesting to see which direction also they are taking.
Mihir, I'll come to you. You did talk about two very important points, consumption, the capex that needs to be the focus of this budget to really propel the economy going forward, and of course the markets to be encouraged as well. But I also want to ask you one thing. What could be a deal breaker in this upcoming budget? What do you think the markets will absolutely not like and will not be able to digest after this 4 months of consolidation? Could there be anything that could be more negative for the markets in the budget?
Well, any increase in taxes for the existing taxpayers obviously is a deal breaker, whether it's cap gain tax or personal tax. I'm actually expecting or hoping for the opposite to happen, some relief on the tax personal income tax side. Let's put into perspective the fact that in spite of we having implemented a good GST system and all, and we have seen good tax collections on GST, direct taxes are now more than indirect tax collections in the overall collections. That's one. And within direct taxes, you have personal income taxes, individual income taxes more than the corporate taxes. So I think we have really milked out the white collar and the urban salaried taxpayer at the cost of the while giving sops to the corporate sector. So I think we are pretty much stretched as far as the existing small pool of taxpayers are concerned. And we need to work on the opposite direction. Second is any hint or any mindset change in the government towards more freebies, more profligacy at the cost of capital expenditure also would be seen as a negative for the market.
Up next, we're going to be discussing all about what the Nifty Bulls expect from the upcoming union budget. And to discuss this, we have a very special guest joining us on the program. Mr. Arvind Sanger, Managing Partner at Geosphere Capital, is with us on this show. Warm welcome to you, Arvind, and thank you so much for taking the time out. I think that's the big question that everybody is asking from the upcoming budget. But I want to understand from you, you've seen so many budgets and in sync with the markets. Do you think this time around a lot hinges on what the budget document could contain? Are the markets really leaning onto the budget to revive spirits back?
I think it becomes more important than most normal budgets. In the past, our assumption has been the budget is largely a non-event, and the best thing that the government can do is do no harm. I think this time, with any big surprises, this time I think there needs to be a little bit more way to revive this private sector and the consumer, because I think that clearly it has become too dependent on government infrastructure spending, and the private sector has not followed through in terms of capex, and the consumer is clearly struggling, both rural and now even urban. So I think that the government will have to take some bold steps, and if that means, in my opinion, some tax cuts, some other incentives to revive spirits, even if that means a little bit widening of the deficit. I think growth is important. Pro-growth budget is very important, although I have to commend the government for having been very disciplined on the fiscal deficit front. But at this point, maybe the expectation should be that growth will make up for any, mathematical shortfall that may appear from being a little more bold in terms of incentives.
Very important point right there. The markets would be happier if it is a pro-growth budget, even if it comes at a tad bit cost of widening of the fiscal deficit. But we do need boosting of the consumption as well as private capex to kickstart its cycle right now, right here. Okay, but I want to understand from you, Arvind, how are your foreign friends really looking at India at this point in time? I know you have seen this entire exodus that has taken place. The FPIs that have pulled out all the money, at least from the secondary markets per se. Do you think, are they looking at any announcement that would interest them to come back to India at all?
Well, let's be clear. What are the mega trends going on globally? The mega trend going on globally right now is AI. Is India a winner or loser? Right now, it looks like India is on the outs, and it could potentially be a loser, especially because if you look at everything that is going on with using AI for programming, that could be harmful for IT service companies at the low end, the mass market, because there will be less programming, outsourcing needed for the low-level programming. So there's one AI trend that is hurting. The other thing is President Trump has talked about reviving animal spirits in the U.S. even further than what it already is, with better or lower regulations, maybe cut in taxes. So that is also causing desire to be in the U.S. markets. The Fed is in between. It's not pushing liquidity, but it's not taking out liquidity. So I think India has to offer something where the growth comes back for people to come back in a market that is looking at other macro trends and not seeing how India is kind of a big winner. So if we get more deregulation, if we get more pro-growth, then the growth excitement can come back. Otherwise, India becomes, it's an interesting market. Short term, it's a good long-term growth story, but there is no compulsion in the short term to come back.
Absolutely. Now, Arvind, another space that I wanted to your view on is when it comes to being a deal breaker or a deal maker, what is it that the budget could carry for the markets and the investors at large?
Well, deal breaker, in my opinion, would be trying to raise taxes, to raise more money so that the government can spend more on infrastructure. Obviously, tax collections have been disappointing this year. There's no two ways about it that corporate taxes have really struggled. But raising taxes to then revive growth through government spending, and then maybe increasing some consumer outlays, I think is the wrong way to go about it. I think it's better to put more money in the pockets of consumers. It's more beneficial to give some incentives for businesses to feel more confident. And I think maybe we shouldn't underestimate anything that the government can do on the regulatory side, which doesn't cost money, but any big announcement on that front, privatization, deregulation, anything that, that is kind of a free market budget. And if they do some announcement, big privatization, it raises money, but it gives the idea that the government is going towards a more private sector. And that I'm just throwing out a few ideas out there. I'm not sure which of those make sense, but something that needs to be a little more bold, in my opinion.
Sure. Mr. Sankar, I want to circle back to something that you pointed out, and I want to bring that into a context. You did say that the big theme and the trend that's worldwide important to see is AI. We did see the DeepSeek issue, and some of the stocks even in India reacted despite not being, directly or indirectly linked. I want to really understand from you, one, we have a new president in the US. Two, we are already getting to know that, tariffs are going to be on top of his agenda. Three, we know that the FOMC meeting has come in, and with the hawkishness that they have spoken about, overnight as well. What exactly is it that globally will be important for India and Indian investors to keep in mind? And will the template for investment in markets this time around change from what was earlier?
I think that the thing that is clear is, President Trump is so focused on deficits that tariffs is his preferred tool. India is not at the top of the list, but it still has a trade merchandise deficit. It has a surplus with the U.S., Fortunately, it has an even bigger surplus on the services side, and that's not an area of focus for Trump. So I think if the Indian government, gives a little bit token benefit of more commitment to buying defense, maybe buying more LNG from the U.S., these are easy gives for India, and it can escape, hopefully, the tariff incremental, aggressive approach that President Trump likes to take. And so I think that hopefully India is not going to have much of an impact from tariff, which would actually be a positive, because there are other areas, whether it's China or it's Mexico, and surprisingly even Canada, which are being threatened with tariffs, and EU could be. So I think India is in a better position on that front.
With that, viewers, it's time to wrap up today's edition of Budget Unlocked, but do stay tuned as we will continue to get you all the insights that you need to know and to prep yourself well right ahead of this biggest financial day that we're going to be seeing on 1st of February, the Union Budget Day.